Welcome to another edition of Pizz-Spectives. My name is Pizzichetta, founder of Mont Wealth, and today we're taking superannuation from I know it's important to I'm confident and strategic. We'll unpack what super really is, the different vehicles you can use, which is retail, industry, and SMSFs, the tax advantages and contribution rules, smart transition to retirement tactics, and demographic way of reshaping retirement planning. Along the way, I'll talk a little bit about did you know and insights you might be surprised with, and some facts, as well as I'll bust some of the myths. Now, again, this is general information only. Anyone acting on this advice without seeking professional advice does so entirely at their own risk. So please give me a call or go and seek a financial advisor. Now, super is Australia's compulsory preserved retirement savings system. There are three pillars keep it sturdy, which is universal coverage, compulsory contributions, and preservation until retirement. Now, from 1 July 2025, the superannuation guarantee sits at 12% of your ordinary earnings. So for most Australians, you're building retirement wealth every time you get paid. Now, did you know that inside super, earnings are generally taxed at up to 15% while you're in accumulation? But once you move money into retirement phase, the earnings are tax exempt. Now, some myths. Super is a government piggy bank they can take. No, your super is held in trust for you. Rules may change, i.e. caps, but it's your money. All funds grow the same. No, fees, asset mix, implementation, and governance differ. A 1% net return can compound for decades and is huge. And the other myth is, I'll worry about it later. Compounding favors the early and consistent. Waiting quietly costs you. So we'll talk a little bit about it as well. Now, I'll just take the minimum in retirement so I don't run out. Minimum only can undercook lifestyle. With a plan which includes buckets and products and drawdown rules, you can spend more confidently. You might be surprised to know many retirees leave large balances unspent because fear of longevity outweighs a plan. The fix isn't guesswork, it's a design. So if you're in accumulation mode, i.e. building, you need to determine what kind of risk you're prepared to take, but also understand that being too risk averse may hinder the outcome. You should think about what your retirement goals look like in today's dollars and back solve how to get there. This is where good financial advisor and plan can help. Now, choosing your vehicle. Think of super as a structure. Inside it, you choose a vehicle that suits your control, cost, and complexity. Now, one of the structures is retail platforms. These include broad menus of powerful reporting and via the tools that often integrated super plus pension plus investment account. Some examples, but these aren't endorsements, include Net Wealth, Hub24, Macquarie Wrap, BT Panorama, AMP North, CFS, which is Colonial First State. And so it gives you a bit of an example of what they might be. Now, the strengths are the open architecture, which allows you to tailor it around managed funds and ETFs and models and sometimes direct equities, consolidated reporting, flexible portfolio construction. But be aware that the total cost includes admin, investment fees, and option complexity. More choice can mean more decisions. Industry funds are large not-for-profit funds with scale benefits and strong defaults. Now, you've probably seen a lot of these guys advertised on TV. And again, examples are not endorsements. Australian Super, Host Plus, Uni Super, Hester, Rest, and Cbus. Now, the strengths are their sharp pricing. As we know, low cost. They always highlight their low cost. Simple, diversified options, robust default, My Super. Menus can be simple. Great for set and forget. Less ideal if you want granular or tilts. SMSFs give you control with some responsibility. Now, SMSFs or self-managed super funds for investors who want maximum control over assets and strategy. There are trustee structures. These are very important. So there are individual trustees, and each member is a trustee, or corporate trustee. You might be surprised to know that a corporate trustee often simplifies member changes, signing, continuity, and succession, and is widely preferred for long-term governance, though there's company setup and asset fees as a result. Responsibilities: keep the fund complying, maintain a written investment strategy. This is where a financial advisor can help you do that. Ensuring there's insurance and liquidity considerations, arrange independent audit annually, and stay inside contribution benefit rules. So you have to be quite responsible as the member or director of the trustee. Now choosing a vehicle is a bit of a rule of thumb. Simplicity and scale, well, use the industry fund. Breadth and tooling, retail platform, and bespoke controller responsibility, a self-managed super fund is ideal, but remember you need a corporate trustee. Now, there is contribution buckets that we need to consider. Concessional contributions are pre-tax employer, super guarantee, salary sacrifice, and personal deductible contribution. And there's non-concessional contributions. So these are after tax without a deduction. The concessional contributions, there's a cap of $30,000 per annum in the current financial year. There's a carry forward. So if your total super balance is less than $500,000 the prior 30 June, unused concessional contribution cap from the last 5 years can be added on top of this year's cap. So Division 293, if income plus concessional contributions are greater than $250,000, an extra 15% contribution tax applies to some or all concession contributions, which is effectively a 30% on that contribution. Now, did you know that concessional contribution cap includes employer super guarantee contributions? That's the most common cap breach. Always coordinate salary sacrifice with payroll. Let's say Gracie has a total super balance at 30 June of about $420,000. Last year, she only contributed $20,000 of concessional contributions, and she had $10,000 unused. This year, she can do $30,000 plus $10,000, total of $40,000, subject to her own cash flow and tax position, and that's a bigger deduction now and more dollars compounding a concessional tax rate. Please seek tax advice. Another example is that salary sacrifice versus take home. Now, at a 39% marginal tax rate, every $1,000 salary sacrificed faces a 15% contribution tax or $150 instead of 39% or $390 in your name. That's $240 saved up front before compounding. Again, seek tax advice. Now, non-concessional contributions. There's a cap here of $120,000 per annum. That started on the 1st of July 2024. You need to be eligible to do this. You need to be under the age of 75 in the trigger year. You can bring forward up to 3 years and contribute $360,000 in one go. Now, there are caps here, total super balance. So if your total super balance prior to 30 June determines whether you can do 360, 240 or 120, or zero if the total super balance is at above the general transfer balance cap. Now, it doesn't count toward the non-concessional contribution cap, government contributions, certain personal injury contributions, rollovers, small business, CGT concessions, and downsides. Let's just say Tom, who's 62 with a total super balance of 1.4, triggers a $360,000 non-concessional contribution. He's effectively preloading the money he wants to earn tax exempt once he starts his pension. Powerful as you approach retirement, and especially relevant as the general transfer balance cap steps up to $2 million from 1 July 2025 for future first-time pension commencement. So to claim the deduction for personal contributions at these ages, you need to meet the work test of 40 hours in 30-day period in that financial year, or satisfy the one-off exemption. Contribution tax on concessional contributions typically 15% plus the 293 for higher incomes. Earnings in accumulation up to 15% and capital gains often 10% after 12 months. Earnings in retirement phase are tax exempt. Did you know that even if you can't get money into retirement phase immediately because of the transfer balance cap, you still harvest the 15% or 10% CGT while in accumulation? And that often beats investing in your own name for higher tax bracket clients. So let's talk about the transfer to retirement, the TTR, a smart tax swap. A transition to retirement pension can start once you reach preservation age, even if you're still working, while the transition to retirement before you meet the full condition of release like turning 65 or retiring. Earnings are taxed like accumulation up to 15% and don't count to your transfer balance cap yet. When you meet a full condition of release, the transfer to retirement becomes a retirement phase income stream and it counts the transfer balance cap and earnings become tax exempt. Now, it sounds a little bit complicated, but it's really not that difficult. Use the transfer to retirement to keep take-home pay steady while maxing your salary sacrifice to concessional contributions $50 inside super. Build a near-term cash bucket inside super for withdrawal so your growth assets can ride out volatility before retirement. Temporarily use transition to retirement income instead of selling assets outside of super and triggering the CGT. You're smoothing life costs while still contributing pre-tax. Now, if you're close to 65 and you want your first retirement phase to start to align with the $2 million transfer balance cap, remember from 1 July 2025, you can pay to sequence commutations or starts carefully. Now, please seek individual advice. You might be surprised to know many miss the transfer to retirement window because they assume it's just admin. done well. The transfer balance cap from 1 July 2025 is $2 million. The lifetime amount you can move into retirement phase for tax-exempt earnings above that stays in accumulation. Now, the transfer balance account is your personal ledger tracking credits and debits. Proportional indexation of your personal transfer balance cap depends on your highest ever transfer balance account. The total super balance, a 30 June snapshot that controls contribution eligibility, non-concessional contribution, bring forward concessional contributions, and carry forward. It's not a cap on how much you can hold on. Now, Kate started a $950,000 account-based pension in October 2024. Later commuted another $200,000 when the general transfer balance cap lifted from $1.9 to $2 million, 1 July 2025. Her highest ever transfer balance account was $950,000, which is 50% of the 1.9. So she gets 50% of the $100,000 uplift. Her personal transfer balance cap rises to $1.95 million. Now, always confirm the transfer balance account and total super balance via the MyGov ATO or your fund before big transactions. It's the cheapest insurance you'll ever buy. Again, seek tax advice or personal advice. Now, the life stage playbook might help you here because it breaks down each decade of life and kind of gives you a sense of where you need to be and some strategies that you can work towards. Now, in your 30s, set the compounding flywheel, automate contributions, pick a growth appropriate option, and consolidate stray accounts. Use caps wisely. Concessional contribution cap includes employers, super guarantee, overflow goes to non-concessional contribution if you want to push harder. Now, in your 30s, now seek financial advice, but you probably want to be targeting other things, i.e. purchasing a home or other investments or just cash flow for personal purposes. Now, here's an example of making your money work harder for you. Let's just say you're 35, you start with a $100,000 super balance and you contribute $2,000 a month as part of your super guarantee. Now, you do this for 30 years up to the age of 65. Now, at 8% return per annum, this simple strategy here gets you to $4.07 million by the time you're 65. Now, if you're a little bit more risk averse and you're wanting to take a much more conservative, balanced approach for those 30 years, then that $100,000 only accounts to 2.61 at 65. That 2% return difference is $1.46 million over 30 years on this plan and can be quite impactful to your retirement. Remember, going back to that earlier comment around the differences between retail super funds and industry super funds, and even whether you want more control of your super within an SMSF. Now, in your 40s, structure and tax efficiency. Max out your concessional contributions to $30,000 per annum. Harvest that carry forward. Remember the total super balance of less than $500,000 where you can do the carry forward and deductions. Remember, you've got 20 years before you're still having to retire, so there's a long way to go. Have a look to see whether you maybe are a bit too risk averse or whether you need to take a bit more risk to achieve your outcomes. Now, think about spouse equalization, contribution splitting, and spouse contributions build two meaningful balances. Great for that transfer balance cap later, and non-concessional contribution flexibility later as well. Do an insurance audit inside your super, TPD, and income protection. As your family profile changes, an example here, your average $20,000 concessional contribution for 3 years. If your total super balance is less than $500,000, you may bring forward the unused to push above $30,000 this year, especially effective in bonus vesting year. Just coordinate with payrolls or employers, guarantee, and sacrifice sit within your available cap. In your 50s, accelerate and position for pension phase. Non-concessional contribution bring forward up to 360 eligibility. Recontribution strategies can lift tax-free component. Get tax advice here and think about how you want to leave a bit of a legacy later on in life. Spouse equalization, aim both partners at their own transfer balance cap. The kids have potentially finished school or out of the home now, so you've got more money to be able to allocate to super. Deploy that 360 non-concessional contribution if you can. Match the concessional contributions each year. And as a result of that, you're seeding a larger tax-exempt pension base when you flip to retirement phase. Now, in your 60s, think about the income design, the sequencing risk, and the home. Choose your start date for retirement phase, intentionally transfer balance cap impact, consider staging, equalization, and what to keep in accumulation. Now, think about buckets here. Hold about 1.5 to 2 years of drawdowns in cash, TDs, to avoid selling growth assets after market falls. Downsize the contribution from the age of 55. Now, up to $300,000 per person from the sale of the family home, which is outside of the non-concessional contribution. There are some conditions here. You need to have lived in the home for more than 10 years. You need to contribute within 90 days of settlement. Now, this is great for topping up super if you've already used the bring forward. Just remember, age pension means test once funds move from the exempt home into assessable assets. There is a demographic wave and longevity which plays an important role in planning for financial advice. You might be surprised to know that Australian super pools are already around the multi-trillion mark and is projected to pass 11 trillion in the next 2 decades. It currently sits at about 4 trillion. So the 65-year-old cohort keeps growing, people are living longer, and the share of members in retirement phase is rising. That means more Australians will spend 20 to 30 years drawing down super, not just 7 to 10 years like many imagine. So what does it mean for your plan? Longevity risk is real. Design your income so you spend without fear. Build buffers and rules. Behavior is half the battle. Minimum only withdrawals often under-deliver lifestyle. So did you know that a rules-based spending approach that blends stable income for essentials and market-linked growth for discretionary spending, plus cash buffers, can raise sustainable spending and help you stay the course? Know your numbers. The value of advice. Australians are far more likely to feel on track, retire on their terms, and make confident decisions. That isn't magic. It's the compound effect of caps, used dates chosen wisely, spouse balancing, transition to retirement timing, and income design that fits real life when the rules shift. And they will, and your plan shifts with them. So super isn't a black box. It's a tax advantage engine with rules you can use. The combo of compulsory contributions, concessional tax, and tax-exempt earnings in retirement can deliver the lifestyle you want. Pizzichetta from Mont Wealth. Thanks for listening, and as always, get personal advice before acting. See you next time.